2024 ended with the S&P up more than 20%, but what this also meant is that many stocks coming into 2025 are trading at some very high valuations, well above their 5-year averages. And if we take a look at one analyst, Tom Lee, who did have a fairly strong 2024 prediction, he believes there's only going to be 10% upside to the S&P into the end of 2025, and he is not alone. We have some major banks who are reporting they only see growth around 10%, in fact maximum 14%, and what today's episode is about are 5 quality stocks that we are buying that we see outperforming the S&P and very strong potentials for outperformance over the longer term. Now the first one, ASML, we have covered this many times, one that we have spoken about, that we have bought towards the end of 2024. Now they effectively design and manufacture advanced lithography machines, and these are used to produce microchips essential for semiconductor fabrication, as well as their cutting edge technology that enables the creation of smaller, faster and more energy efficient chips. Now if we take a look, they haven't had the greatest 2024, they were down around 3%, but over the last 10 years they have massively outperformed the S&P, up 579%. Right now they are trading towards their 52-week lows, and we get a double buy rating from both Seeking Alpha as well as Wall Street, and they pay a dividend yield which sits around the 1%. Now, if we take a look at this company in terms of their earnings, what we really like to see from companies we want to consider is strong growth over the next year, and ASML shines through with double-digit growth anticipated on the earnings per share year-on-year comparison. And on top of that, the last 4 quarters have been fairly sizable beats, giving them a 100% historical forecasting accuracy. Now looking to December 2025, that is their next full accounting period, with the EPS estimate of 24.2, they anticipate the forward P to sit around 29, and that is where we see the forward P right now, and that is significantly lower than the 5-year average, as we can see here at 34.1. Now, as we will go through each of these companies, we're going to look at some of their ratings. Now, they do get an F on the valuation. What we would say is they have used an older reference to the P on a non-GAAP basis, but even with the updated 29, that is still above the sector median of 25.1, and we do in all honesty believe that no matter with the numbers, this company is trading at a premium when you compare it to the sector median. As we have said on previous episodes, some companies do deserve the premium. ASML is one of those. However, we do notice the growth grade does lack a little bit with the B-, as we can see year-on-year revenue growth -2%, the sector at 5%. Also bear in mind this is in the semiconductor space, which is cyclical, but over the next 12 months they anticipate 13% of revenue growth, which is above the sector median at 5.5%. The other thing that we will point out that does give a bit of a lackluster rating is that the earnings per share of 17% is only marginally higher than the sector median of 15.5%, and bear in mind this is estimated for the next 3 to 5 years. One thing though that they do score very strongly on is their profitability at an A+, where their gross profit margin of 51% is in line with the sector median, but their bottom line, that is a very impressive 26%, when the sector median comes in incredibly low at 3.8%. The other really strong point about this company is the cash they generate from operations, $5.4 billion over the last 12 months against the sector comparative at $100 million. So just quickly going through ASML, as we said, a double buy rating. It does get the F on valuation, although we do believe it deserves the premium to the overall sector, B- on growth with an A+ on profitability. Now with each one of these companies, we are going to run them through the valuation model, where in today's episode we get an intrinsic value of $1,000, and this is derived from the DCF model. Now we can show you, we have the free cash flow year on year. The average growth rate of this company over the last 10 years is 35%, and we've gone a lot more conservative at 18%. Incorporating the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, $1,000. Bear in mind, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for ASML or any others, but full transparency will show you at the 16% rate if you believe that to be more reasonable, $886, that is still 28% upside, and for those that are a lot more bullish about the industry and the company, 20%, $1,128, and that is 63% upside. Now, as we said, and we always do, we take the median median rate of 18%. Now, using the intrinsic value of $1,000, we don't stop there. We do apply a margin of safety where we kick off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that, in today's episode, a buy up to $900. And as we keep going, you will in fact see that ASML at today's price is showing a very large margin of safety. Not at the 35% level just yet, but up to around $700, you are getting 30% MOS. With Wall Street themselves very bullish, we saw the buy rating. They have a $920 price target where they see 33% upside over the next year. Now, this is one of 5 quality stocks that we are covering today, but with each one, do also give us your thoughts below. Maybe you're buying some of these, or in fact, maybe these don't fit your portfolios, and we would like to hear your reasons why. Now, before we continue, we want to let you know we have just released our latest free weekly article where we cover 2 buy now stocks in the AI industry. Now, every Monday we release one straight to your inbox for free where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, start reading straight away. And tomorrow morning we are releasing 46 undervalued stocks for the month of January. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a copy of 29 stocks that Wall Street themselves believe right now have the most upside in the S&P. So click below, you can sign up and start reading straight away. We then move on to Google, which is a name everyone has heard of, but maybe you don't know the split of their revenue. Whilst the majority does come from the search space, we can also see YouTube making up around 10%. But one thing that we do believe to keep a close eye on is their bets and hedgings. This includes Waymo as a few other projects that they do entail. And for those that don't know, they also develop software, hardware, as well as those specifically relating to artificial intelligence. We're not going to cover them today, but that is something we have looked at in previous episodes. Now, this is a company that has outperformed the S&P both over the last year as well as over the last 10 years, up 664%. And even though it's trading towards the 52-week high, opposite to what we saw with ASML, we do believe this to be a strong contender for one of the best stocks in 2025. We also get the double buy rating from Seeking Alpha and Wall Street. 4.4, not far off the 4.5 to turn this into a strong buy, and Quant with a 3.49, not far off the 3.5 to flip that into a buy. Similar to ASML, they do pay a dividend, although on the lower scale at 0.42%, and we can also take a look at their earnings over the next 4 quarters, not only expecting growth to the EPS, but also 100% historical forecasting accuracy. And if we look at their forward P for 2025, it sits at 21, not only the cheapest in the Mag 7 right now, but also lower than the average of the S&P 500. In terms of valuation, they get an F, not something we agree with as we don't believe it is really in the right sector, but if you are someone that wants to look at this information, you can see the deviations from the sector median. One thing we would say though, in terms of the forward P right now at around 22, it is marginally lower than the 5-year average of 22.5. If we move on to the other ratings, now growth they do get a C+, but their year-on-year revenue is double digits as well as expected over the next 12 months, which is significantly higher than the 1 to 2% respectively for these metrics. And the other thing we do notice is the earnings per share, around 17% growth expected with the sector median at just below 11. In terms of looking at their profitability as well, at an A+, looking very good. Gross margin only a little bit higher than the sector, 58 versus 52. Bottom line though, very high, pretty much in line with ASML, 28% with the sector median at 3.8. And we also notice their cash from operations, one of the largest in the S&P 500, 105 billion, the sector comparative at 283 million. And as we said, double buy rating, although Quant aren't far off, with a C+ on growth and an A+ on profitability. In terms of their metrics, well, our intrinsic value at $215, essentially, as you can see here, we've gone for a growth rate of 12%, which is lower significantly than the average over the last 10 years, lower than the most recent year of 16%, and these are the different upsides depending on the expectations of the growth to the free cash flow over the longer term. So when we do run it through the MOS, at 10%, a buy at 194, at 15%, not quite there yet. So for Google, we see 10 to 15%, which we do believe to be a very good buy at this point, especially with the growth we anticipate over the next year. And essentially, as a longer term stock, we do believe this will continue to outperform the S&P. And in terms of Wall Street, their price forecast $225, lower in terms of the upside over the next year in comparison to ASML, but 19%. That is still one that is anticipated to outperform the S&P if the analyst predictions are correct, of around 10% gain in 2025. We then move on to MercadoLibre, which operates an e-commerce platform online marketplace across Latin America, and it also provides payments, logistics, and financial technology solutions. In terms of the performance, well, in 2024, they are up around 11%, underperforming the S&P, but over the last 10 years, massive outperformance, up 1,291%. Trading in the mid to lower end of the 52-week range, we get a strong buy from Seeking Alpha, a respectable buy from Wall Street, 4.37 out of 5, and then when we do take a look at their earnings, a little bit inconsistent with essentially the next quarter at a pretty much flat 0.42%, but growth is anticipated over the subsequent three. One thing we would say is they do typically outperform quite significantly. However, we did see quite a sizable miss in Q3 of $2.10, which is one of the reasons we have seen the share price come down over the last few months. And in terms of their December 2025 forward P, that does sit right now around 37.5. In terms of the ratings, well, their grading comes in at a D, as we did see, a little bit outdated, but even with the around 37 for 2025, that is still above the sector median. And one thing we would say, a lot of the companies we are looking at today not having the most favorable score in terms of the valuation, but one area they do outperform is the growth and in fact also profitability. So growth at an A, 35% above the sector at 2.2, so you can see why it demands the premium. The same for revenue moving forwards, with the sector still low single digit of 3%. And we also notice earnings per share over the next 3 to 5 years, 30% on a year-on-year basis, with the sector comparative at 10.54. We also see some very respectable profitability metrics at an A+. Gross profit margin 52%, better than the sector at 38%. Bottom line as well, better at 8% versus 4%. And we can also see cash from operations, we're talking in the billions, 6.92, with the sector comparative at 271 million. So one strong buy from Seeking Alpha, one buy from Wall Street with an A on growth and an A+ on profitability. So when we talk about this company in terms of valuation, well, our intrinsic value at $2,216 has essentially come from the DCF model, where we've only used a 6% growth rate moving forwards. Maybe one you believe that is too conservative, or in fact the opposite and too optimistic. You can see here the different upsides depending on the percentage, but when we do run it through the margin of safety calculation, again, similar to the majority of companies today, you are looking at something fairly favorable, around 20 to 25%, with Wall Street very bullish, just under 40% upside over the next year. Their price forecast, $2,359. We then move on to NU Holdings, which operates NU Bank, a digital platform offering financial services like credit cards, loans, and payments in Latin America, and it focuses on simplifying banking with user-friendly technology as well as low fees. And in terms of their performance, well, they are up around 27%, pretty much around the S&P in 2024, trading towards the lower end of the 52-week range, with a double buy rating again from Seeking Alpha and Wall Street. And this one, similar to MercadoLibre, doesn't currently pay a dividend. When we talk about the earnings, well, growth is expected double digit over the next 4 quarters, very high, as well as either being in line or marginally outperforming analyst targets. And we can see, based on their earnings per share, their December 2025, so their forward P, does sit right now at 18.2. We then look at the valuation, where they do get a D, although the true nature of this should be sitting at 18, which still is, in all fairness, higher than the sector median. Although if you are someone that does look at the PEG gap ratio, 0.08, that is looking very favorable in comparison to the sector median. In terms of growth though, you are seeing why we are picking a lot of these companies today, lots of growth anticipated, as well as the historical basis, which is significantly higher than the single digit that we get from the sector median, as well as the earnings per share growth, 372%. In fact, the sector comparative sitting at negative 1.5. We then move on to the profitability, where they get an A-. In fact, gross margin 100%, a lot better than the sector median at 59%. Bottom line, 33%, again better than the sector at 22%. And for those that want to see cash from operations, just under $4 billion a lot better than the sector at 136 million. And as we said, double buy rating, A- on growth, A- on profitability. So in terms of the valuation, our intrinsic value at $15 does give a very nice margin of safety. How much to be specific? Well, what we do in fact notice in today's episode, you're getting at least 30% MOS. Wall Street themselves very bullish, over $17. They see 68% upside. As always, do give us your thoughts about these stocks in the comments below. We then move on to a very well-known brand, Uber, which provides a platform for ride-hailing, food delivery, freight services, and they connect users with drivers, couriers, logistics solutions through their apps, and you can see their split of one of their quarters in FY23. In terms of the company itself, well, pretty much flat marginal growth of 3% over the last year. Over the last 5 years, up 103%, outperforming the S&P. Trading again similar to ASML at the beginning of the episode towards the 52-week low, with a double buy rating, although both seeking alpha and Wall Street not far off the 4.5 for a strong buy. And when we take a look at the earnings, whilst a little bit inconsistent, we do notice a 75% historical record, whilst also with the earnings per share, right now the forward PE sitting at 26.2. When we take a look at their valuation, the PE not far off the sector median of 20, and when we take a look at their growth grade at an A+, revenue year on year looking very good, as well as on a forward basis against the sector median, both again in the single digit. But we also notice the earnings per share over the next 3 to 5 years, 41%, sector median at 11.4. Profitability looking good at an A+, gross margin pretty much in line with the sector around 32%. Bottom line a little better, 10.5 versus 6.5, and their cash from operations in the billions, 6.2 against the millions of 336 from the sector median. Double buy rating, A+ on growth, A+ on profitability. Then we get to the valuation of $93. Again, we are talking about a very nice MOS in today's episode at the 30% at $65. But in fact, for Uber today, you'll look at 35% margin of safety with upside of 57%. Now, a lot of people will say robo-taxis are going to essentially take over the market share from Uber, but maybe that is something over the longer term, not something right now. And with a margin of safety of 35%, maybe this is one to seriously consider. As we said, give us your thoughts in the comments below. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets, new one coming tomorrow morning, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, Happy New Year, and we'll see you all on the next one.